Good morning, everybody, and welcome to our second sustainability webinar for 2025. I just want to confirm, could you please send me a message in the chat box on whether you can see my slides? I've already shared the slides. I just want to make sure everybody can see it. Can you quickly say, hello, Aletta, we can see you, or nothing for us to see? The BDO team, can you maybe let me know whether you can see the slides? Good morning, everybody. I'm just trying to figure out whether everybody can see the slides. Shannon, Stacy, can you just let me know whether you can see the slides? All good? All right, fantastic. Thank you very much to the team that's come back. I think for some a nice technology reason, which I can't explain, some of the BDO team can't see my slides, but others can. I'm hoping all the attendees can see the slides though. So apologies for the slow start, but off we go. Now, in this month's webinar, we're looking at the strategic role of AASB S1 and other voluntary frameworks. So today I'll be presenting on my own. Hopefully Kevin, some of our other sustainability partners will join next month. Now, BDO would like to acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. And we pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples. We would like to invite you to register for our monthly webinars. Last month, we looked at the year of mandatory sustainability reporting in Australia. This month, we're taking more a strategic perspective on voluntary frameworks. And then from next month, we're going to focus the rest of this year to get our clients ready for AASB S2, the mandatory reporting standard. And we're going to do that over 10 months. And our first clients are doing mandatory reporting 31 December this year. So that's the purpose of the webinars this year. We would also like to invite you to join our IFRS and corporate reporting webinars. In particular, in March, we're looking at accounting for power purchase agreements, which a lot of entities are exploring in order to decarbonize their business and to manage the costs associated with that. So please join us for those. Then, back due to popular demand, 2024, this is a huge success story, the Carbon Accounting Masterclasses. We're running it again in March. In Melbourne next week on Tuesday. It's not too late to register. I'm running the Melbourne one in person. So if you want to find out more about carbon accounting, how to get ready, especially how to be assurance ready, please join us for that day. Reach out, register, contact me. Please join us. The virtual session I'll also be running on the 20th of March. And then in Perth, Ashley Woodley will run one on the 21st of March. In Sydney, Kevin Frobers will run one on the Tuesday, the 25th of March. And in Brisbane on the 28th of March, Tom Hochburn will run that. So please join us. All roads lead to carbon accounting, whether it's strategic imperative or compliance imperative. So please register. I usually start these webinars to give you a bit of a roundup on what has happened recently in the sustainability world. Now, we have 2 new approved Australian sustainability assurance standards. And I flagged this briefly in our webinar in January. But, on the 28th of January, we actually saw the final standards, ASSA 5000, which is General Requirements for Sustainability Assurance Engagements, and an important one, ASSA 5010, which includes a timeline. And I've talked about the reporting timeline on several occasions where we know for a Group 1 entity, it is for your financial period beginning on or after 1 January 2025. And for Group 2 entities, it's 1 July 2026 and Group 3, 1 July 2027. The assurance standards includes a table which is flagging how the assurance will be phased in. Now, a number of clients have reached out to us, and there's a little bit of confusion on the overlap between the AASB S2 mandatory reporting and how that overlaps with assurance. And then the one part is that overlap, and the other problem is, there's an asterisk on this table at the bottom which says Group 1 entities with years commencing 1 January to 30 June will have 2 year ones. And a lot of people have said, what do you mean by that? And if I've got a year starting 1 January, for example, I've got a 31 December year end, I fall in that period, I've got 2 year ones. What do you mean? So what I've done is I've prepared a slide to overlay the reporting aspects in AASB S2 with the assurance aspects under this new standard. And really the question is, what does this reporting and assurance and the phasing mean for Group 1 entities, where their years are commencing from 1 January to 30 June. So as an example, I picked, if you're an entity that is starting your year on 1 March every year, so your year end is 28 February, what would it mean for you? But this will be very similar if your year is starting on the 1st of January and your year end is 31 December. What would this mean for you? All right, so just trying to make that crystal clear. So if we look at this, let's say your year is starting the 1st of March every year. So the 1st of March 2025 will be the start of the first financial year after 1 January 2025, and therefore this client will have to do mandatory reporting the first time 28 February 2026. So from 1 March 2025 to 28 February 2026. From a reporting perspective, they will have to do mandatory disclosure of governance, strategy, all strategy, climate resilience, transition plans, risk management, scope 1 and 2, climate-related metrics. They have to do everything in AASB S2 except for the one no, and that's scope 3 emissions. So that's fairly clear. And if you look at the reporting column for 28 February 2027, we add scope 3. And then from 28 February 2027 onwards, it's always you comply with absolutely everything in AASB S2. So I think everybody's got that right. So that's the phasing for reporting. But how does the limited assurance phasing work? So if you're a Group 1 entity and you've started your year between 1 January and 30 June, you've got 2 year ones from an assurance perspective. It doesn't change anything from a reporting perspective. So what will happen here is in your first year, 28 February 2026, you'll only need limited assurance over governance, certain paragraphs of strategy, and scope 1 and 2. All right, so you've got relief, the red blocks on most other aspects. Then if you look at 28 February 2027, your second year, um, although you do reporting of everything, you still have relief, limited assurance only over 3 aspects, and relief for the rest. So because you are starting between 1 January and 30 June, you've got 2 years of limited assurance relief. You've got 2-year ones from an assurance perspective. It doesn't change your reporting. And then from 28 February 2028, it's compliance with every aspect of AASB S2 and limited assurance. So I just wanted to clarify this. We've received so many questions on how does the reporting phasing and limited assurance phasing work together. Please reach out to me if you've got any further questions. I think that's a really important aspect. Speaking to clients, and I was at a client this morning, you have to do all the reporting, so you have to get ready for that. But I think the phasing of the assurance gives organizations some time to make sure that they can withstand assurance and they've got audit documentation in place. So this is really good news for entities within Australia. Then I would like to touch on the 2025 CFO Outlook Survey. Now, in previous years, we've also looked at it. It's a survey conducted by BDO in the US. And I was eagerly waiting for this report because we've all heard that President Trump has pulled the US out of the net zero commitment, etc. And I must say, when I'm speaking to clients at the moment, the very first question they ask me, what does President Trump's views around net zero mean for us in Australia? We're on this path to mandatory sustainability reporting. Is it going to impact us? Now, BDO in the US conducted this survey. And they've just last week released the survey results. And I want to step you through this because it's been absolutely fascinating to see what CFOs have said, what their views are. And this is the survey conducted after President Trump has been elected. So they knew what was coming very clearly. So I want to share this one. So the CFO Outlook survey, there's a link to the survey published by BDO in the US. But I think it's just to address some of the questions we received around President Trump's announcements. The methodology, I thought I should put in the methodology. They polled 500 CFOs. Large businesses in the US, so revenue from 250 million to 3 billion. And we know that would be our Group 1, Group 2 entities in Australia, so it's very relevant. They polled them in November last year after the presidential election. And then they also put in some quotas to limit larger companies and smaller companies to best reflect the middle market. So we want to get a middle market perspective in the US. They covered various regions. You see Asia Pacific 4%. They covered industries. They've covered, that's the sizes of the organizations that participated. So quite a comprehensive study. So that's the methodology. Interestingly, so there's a few, you can look at the survey yourself, but I want to, flag a few interesting things. The US election, how would that impact on 2025 investment plans? So they asked CFOs, will you increase investment across all these aspects, or will you decrease investment? Interestingly, if you look at sustainability initiatives, still 44% of the CFO says despite the US election outcomes, they will still increase investment around sustainability. You can see other areas that they will invest in: technology, strategy, AI adoption, research and development. But sustainability is still there in the top line, which is interesting. They're not backing away from it. They also asked a question, areas where CFOs will increase involvement in strategy. And again, they want to look at digital transformation, etc. But still there, 47% top line, ESG strategy and execution. Still where CFOs are getting more involved. And this is in a country where President Trump, they don't have mandatory reporting. They've backed away from net zero commitment, but they still invest in ESG strategy. Then there was also a question around the 2025 risk landscape. And again, what are the risk areas of significant concern for leaders in 2025? Again, in the top line, ESG risk, 45%. This is a fascinating report to read in detail, but I just wanted to flag some of that. Maybe I think it's the last slide from the CFO Outlook survey is sustainability as a growth driver. If you look at your current sustainability strategy, they said 40% of the CFOs that look at their current sustainability strategy would say we are primarily focused on meeting stakeholder expectations. And that comes back very nicely to what we're talking today about, and that is voluntary reporting and voluntary frameworks. Because voluntary reporting is absolutely focused on who are your stakeholders, what do they want, how do we meet their expectations. So you can see in the US, 40%, the biggest part of it is about stakeholder expectations. You can see that mandatory reporting is the second one, the 30%, primarily focused on compliance with sustainability and ESG regulations. So that's a second place in the US because the mandatory reporting is more state-based and it more impacts businesses that are dual listed in the US and maybe in Europe, where they're pushing ahead with CSRD and European sustainability reporting standards. Interestingly, motivated by compliance and stakeholder demands, most organizations are actively implementing sustainability strategies. And as they implement these strategies, businesses must maintain an agile approach to adapt to potential shifts in tax credits, other regulatory processes, and the new administration, the new president and Congress. But I found it really interesting that 40% are saying we're focusing on stakeholders, we respond to what stakeholders are asking for. That is voluntary reporting. That's what we're talking about today. And then, another slide where they said, what are the benefits from sustainability initiatives over the last 5 years? And I thought this is absolutely fascinating. These are CFOs that's looked at sustainability initiatives for at least 5 years. So what do they see as benefits? Increased innovation, new business opportunities tops the list. I mean, that's what we want to see. Businesses want to grow. They want to innovate. They want to see new opportunities. 37%. Increases in revenue. 36%. Absolutely amazing. Access to favorable financing or investment opportunities. Absolutely. That's what we're talking about, voluntary reporting. It's access to financing, access to capital. And this is what CFOs are saying. Improved risk management, broader risk considerations, informed decision making. Can you believe it? Cost savings. 30% of them reported cost savings. Now look at this. Increase in revenue plus cost savings. That's amazing for your gross profit. Enhance customer loyalty, access to markets and customers, attracting and retention of talent, so access to people, access to new markets, and then right at the bottom, reduced environmental impacts and reduced carbon footprint, 23%, which is amazing. But I find it fascinating that sustainability initiatives have actually been good for the financial numbers, increased revenue, reduced cost, better risk management, access to capital. This is what we've been talking about for a long time, and this is what CFOs have validated. and this is what they've seen over 5 years. And then 37% will invest in employee training and development to improve business resilience. And again, you can see what are the sustainability and ESG focus areas: employee health and well-being, cost reduction, as one, climate change mitigation, carbon footprint reduction, better corporate governance, a number of focus areas, but amazing that this is driven by stakeholders. So some of the key takeaways is, employee well-being is a resilience strategy. Strategic tax planning remains key. Sustainability-driven growth will play a larger role in overall strategy. So CFOs are increasingly seeing sustainability initiatives as a potential catalyst for business growth. And this relationship shapes three major considerations for 2025, which is outlined on the right. Absolutely fascinating findings. So that was a survey done across CFOs, and there was a lot of aspects in there, not just sustainability, but AI, etc. However, BDO US then went further, and they published a CFO sustainability outlook survey. So specifically asking questions around sustainability, and there is a link to that report. And again, a fascinating report to read. Again, they provide the methodology that you can look at. But these are some of the key things. And again, everybody's talking about President Trump, but these reports are really saying, whatever President Trump is doing, we are seeing revenue cost benefits, revenue increases, cost benefit, strategic growth, and that's why we're doing it. Our stakeholders want it. So the US presidential administration may have changed, but sustainability remains at the top of CFOs' agendas. And that's the key takeaway here. Highlights, three highlights. 91% of organizations that are integrating sustainability into their business strategies expect increased revenue in 2025, because earlier we see they've already seen increases in revenue, and therefore they're continuing to invest and they expect revenue increases. This is good for the bottom line. 80% expect their involvement in ESG strategies to either stay the same or increase. And I know why. If you see more revenue and you see cost reductions, of course you're going to stay the course. And then the last one, 77% of CFOs plan to maintain or increase their sustainability investment this year. So the one is about ESG strategy, and the other one is their investment. So interesting stuff. Again, business benefits from sustainability initiatives. That's that 5-year retrospective view. This is absolutely fascinating. I've touched on an earlier, a slightly different way to look at it. I'm an accounting nerd and I like to make money. So my eyes go to increase in revenue, 36%, cost savings, how amazing, and then all the other aspects together. But we can see this is good for bottom line. Top business benefits by industry. So if you look at manufacturing, absolutely top is increase in revenue, increased innovation, improved risk management. If you look at technology, increase in revenue. If you look at retail, broader risk considerations, informed decision making. 37% improved risk management. 34% access to favorable financing, cheaper financing, or investment opportunities. How amazing. Life sciences, 43% enhanced customer loyalty. Healthcare, increase in revenue. So really interesting, the benefits by industry. Some of the takeaways that we've got, there's a lot of benefits, but exploring, identifying industry-specific opportunities, balancing short and long-term priorities. And the last one is interesting. Finding opportunity and risk. If you do a climate risk assessment, or you do a risk assessment across sustainability to say, how do I turn that risk into an opportunity and explore and turn it into growth for the business? State of sustainability strategy. The current approach to sustainability, again, there's 40% are primarily focused on stakeholder expectations, which is important, and then regulatory compliance, etc. And then on the left, I've said, while CFOs report measurable business benefits from past ESG investments, many organizations still treat sustainability as a distinct initiative instead of a core component of overarching business strategy. And therefore, I think our suggestion is to keep, sustainability has proven to have fantastic benefits to businesses. So don't keep it separate, embed it in your overall strategy, and it will even fast track those benefits. Then I think I like this one, revenue and profitability expectations. I'm a real accounting person. Here they said, if you look at all respondents, 74% increased revenue, 23% said no change. Only 3% said decreased revenue if they've implemented sustainability. If you look at all respondents, profitability, you don't want to grow revenue and not grow profitability. 56% said we have increased profitability. 38% no change, and only 7% decreased profitability. And then on the right-hand side, if you look at integrating sustainability, they would say increased revenue, 91%, no change, decreased revenue. And if you look at increased profitability, 69%. So what's interesting here, on the left-hand side, you have all respondents. Have they seen increases, no changes, decreases, etc.? On the right-hand side are the entities that's actually integrated sustainability. So on the left-hand side, 74% said increases in revenue. On the right-hand side, if I've integrated sustainability, I see a 91% increase in revenue. On the left-hand side, I've seen decreased revenue of 3%. On the right-hand side, people who integrate sustainability, no decrease in revenue. If you look at profitability, on the left-hand side, everybody, yes, we've got increased profitability. On the right-hand side, by 56%. On the right-hand side, if we've embedded sustainability, increased profitability by 69%. So you can see on the right-hand side, those who've integrated sustainability are outperforming all respondents. So you can see the clear benefit. Again, some takeaways: don't silo sustainability, embed it. Connect strategy integration to return on investment. Let's work out what are the benefits of doing sustainability, and prepare more disclosures regardless of the operational scope that you have in your country. And then again, coming back to our sustainability in the new administration, the words that I'm hearing a lot, and I see it on the screen here and I saw it in this report, are the words businesses plan to stay the course or increase their investment in sustainability investments. Last Friday, I've attended a lunch by the European Australian Business Council. And the person who presented at this lunch is the Director General for Climate Action at the European Commission, Kurt van den Berg. And he used exactly the same words, and that is the EU, the European Union, intends to stay the course on decarbonisation and sustainability. And actually, they intend to increase innovation and investment. And then when I read this report, I see similar words around staying the course. And again, here you can see the election impact on sustainability investment. Overall, there will still be an increase of 44%. 33% will say we'll stay where we're at, and a decreased investment of 22%. So we do see some decreased investment, but overall businesses are saying we'll stay the course. This again, what areas of sustainability and ESG are you planning to focus on in 2025? So this is broad sustainability. These are not mandatory aspects, and you can see the number one is employee health and well-being, 40%, sustainable product development, 39%, cost reduction strategies and focusing on 35%, supply chain, etc. Climate change and mitigation 26%, governance 23%, carbon footprint reduction 22%. So again, a wide spread of initiatives that are getting attention of CFOs. Again, the top 3 initiatives by industry. So if you look at manufacturing, cost reduction. If you look at life sciences, sustainable product development, healthcare, employee health and well-being. If you look at retail, cost reduction, and then technology, sustainable supply chain management. Remember, these are the top initiatives, the top 3 sustainability initiatives. And I think people are catching on to the fact that cost reduction and sustainability go hand in hand, which is another interesting takeaway. And then again, if we look at increased CFO involvement by industry, if you look at 2025 compared to 2024, across all these industries, in 2025, CFOs will increase their involvement. 2024, that's what they told us, the grey. 2025, this is what they intend to do. They're starting to see the benefits more and more, and it's based on past experience. So again, don't lose sight of state and international regulations. It's important to get ready for that. Increase engagement to build momentum. And then focus on sustainability opportunities explicitly tied to business value. CFOs want to create business value for the business. That's what the CEO wants. That's what the board wants. That's what the stakeholders want. So, focus on these opportunities that will increase revenue and reduce costs. Then they also looked at sustainability as a growth driver, which we've touched on earlier, focusing on stakeholder expectations. So I think it is an absolutely interesting 2 reports, putting in perspective what's happening in the US. And this is coming from BDO in the US, a survey after the presidential election. And the word is stay the course. And the message we're getting out of Europe is they intend to stay the course. Europe might, temper their enthusiasm because they've gone really fast with 12 standards, when in Australia we have 1 standard. So they might slow down a bit so everybody can catch up with them, but they intend to stay the course. So if we look at all of that and we say, why is sustainability important today in Australia? We see it's important in the US. We see it's important in Europe. Why is it important in Australia? And Australia is now, believe it or not, after years that we were playing catch up, Australia is now leading the way, because from a compliance imperative, from 1 January 2025, we've got mandatory reporting. The only other place in the world that is ahead of us around mandatory climate reporting is Europe, because they started 1 January 2024. And New Zealand, for the very large entities, I suppose we should give credit, they're ahead of us. But Australia is now one of the leading countries in this space. So that compliance imperative is pushing ahead. But then on the left-hand side, and that's what we're talking about today, is the strategic imperative. Not-for-profits that are logic with the ACNC might never have a compliance imperative. A lot of entities that are below the Group 3 size threshold might never have a compliance imperative. But strategically, those businesses are saying, we see increase in revenue, we see cost reduction, we see access to cheaper debt financing, we see access to new investors, new markets. Strategically, we don't want to be left behind. So there's a strategic reason to act and a compliance reason to act. Now, that strategic imperative, I've put it in here because as I read those US reports and what they've seen over the last 5 years, so actual findings, I thought this all comes back to access to capital, debt and equity, access to markets and customers, and access to people to work in the business. More or less, all the benefits they've articulated, we can put into one of these three buckets. And we've got some science behind it, or a survey, research behind it. The other thing that continues to happen in Australia is all roads are leading to measuring your carbon footprint, whether it's for strategic purposes or compliance purposes, then setting targets and tracking progress against those targets. It really is now a ticket to play in Australia, a license to operate. So please don't take your eye off that. The compliance imperative, as we've got the assurance standard, and there's 2 new assurance standards that we should consider, and I've explained earlier. We know that a financial report will now also include this annual sustainability report. And for today, we want to look at that supplementary or voluntary sustainability report. So in Australia, the sustainability report defined in the Corps Act will go in the annual report subject to assurance, initially just climate. But if I look at what the findings in the US and the benefits people are seeing across broader sustainability, that takes us to that green block of voluntary sustainability reporting. And that is at this stage sitting outside the annual report. We expect that it will move into the annual report over the next number of years. But, there's still benefits in preparing that. Maybe there's benefits in preparing that in addition to what you do in your annual report if you are a Group 1, 2, 3 entity, or even if you're not captured by mandatory reporting, to have that voluntary reporting aimed at stakeholders still has value. So if you look at those voluntary reporting frameworks, if you're going to do voluntary reporting, how do you start? Where do you get guidance from? Now it's interesting. Some of the voluntary reporting frameworks have more of a financial focus. So it's more looking at investors, financiers, etc. So, an example of that is AASB S1 in Australia, the general requirements for disclosure of sustainability-related financial information. You can see there's that financial focus, is a voluntary standard in Australia, but it has the same pillars that we have in our mandatory AASB S2. It's talking about what's your governance around all aspects of sustainability. What's your strategy across all aspects of sustainability? What's your risk management across all aspects of sustainability? What are your metrics and targets across all aspects of sustainability? And put this in a voluntary sustainability report, and that if this is what your stakeholders would be interested in and would lead to improved revenues or more customers or cheaper debt financing, etc. So this is an option that you could use in Australia for voluntary reporting, and we do expect this to become mandatory fairly soon. I mean, we've got AASB S2 mandatory at the moment. Surely the next mandatory one coming out of the Australian Accounting Standards Board will have to be AASB S1. So good preparation, but it's got that financial focus. The other one that has a financial focus would be the TCFD recommendations. And please don't forget about these TCFD recommendations, because the TCFD recommendations continue to be voluntary for all those entities outside Group 1, 2, and 3. So Group 1, 2, and 3 have taken the TCFD recommendations, they've built on it, and they now apply with AASB S2. But if you're outside Group 1, 2, and 3, there's still some amazing things in here to voluntarily report around climate. So that's a voluntary framework still looking at financial aspects. If we look at a bit of a non-financial focus and voluntary frameworks, we still have the United Nations Sustainable Development Goals, which gives you such amazing goals that you could follow based on what your stakeholders are interested in. Whether it is affordable and clean energy, number 7, maybe it is number 10, reduced inequalities, maybe it's number 12, responsible consumption and production of your product, maybe it's climate action, maybe it is life on land, maybe it's quality education, but which of these goals resonate with your stakeholders and therefore you are aligning to and therefore should be reporting on? Another one to consider, this is the one that BDO Australia uses, is the World Economic Forum have said, we think there are 4 buckets when you look at voluntary broad sustainability reporting. We think there are principles of governance. Tell us about that. Tell us about planet, people, and prosperity. So that's how they bucket it together. You can see a lot of overlap in all these voluntary frameworks because AASB S1 also talks about governance, for example. We've done a bit of a study over the years to say, how do we marry up the World Economic Forum principles or 4 pillars with United Nations Sustainable Development Goals? And this is a way that you could group it together, which aspects in the United Nations Sustainable Development Goals kind of align to principles of governance and which align to people and which align to planet. So I'm trying to articulate that it doesn't really matter whether you follow World Economic Forum disclosures or United Nations goals. It depends on what's important to your stakeholders and how do you articulate that, because it's very much similar. GRI standards, which is amazing standards, and that's been applicable and adopted in Australia for many years. They also talk about, governance aspects. So they've got universal standards that applies to your reporting. They've got sector-specific standards, and then they've got specific topic standards. Now, you'll only pick a sector standard if you're in that particular sector. You'll only pick a topic if that's a topic that's important to your stakeholders. But the universal standards is an overview and more or less a baseline. The other thing that I thought is interesting as I prepared for this webinar is in Europe, they've got European Sustainability Reporting Standards. And people often ask me, what's the link between what we do in Australia and what they do in Europe in these ESRSs? They already have 12 ESRSs, European Sustainability Reporting Standards. And the easiest way to think about it is if we are applying IFRS S1 and S2 or AASB S1 and S2 in Australia, and we are applying the relevant GRI standards, that will get us quite close to European Sustainability Reporting Standards. And there's actually a publication issued by the International Sustainability Standards Board where they say this and they map these standards and show how they are the interoperability of these standards together. But at a high level, so you can see in Australia, if we've got IFRS S2 as mandatory, it's a stepping stone. We still have to do S1, which will be next. The GRI standards will turn into S3, S4, etc. So we are behind Europe, and therefore it's maybe not a bad idea if Europe stays the course, but slow down a bit, because 12 standards is fast and it's It's fantastic, but it's really fast. The rest of the world has to catch up. Um, so the process. There are a lot of voluntary frameworks. Um, and you are not even, if you want to do sustainability reporting on a voluntary basis, you're not even forced or mandated to use any of those frameworks. You can come up with your own approach. The frameworks could guide you. You could be informed by the frameworks, but you don't have to state compliance with the frameworks. You could just use it as research to guide you. So what is that process? Um, if you are a business that are outside mandatory sustainability reporting and you don't think you'll ever be caught by it, and you really want to embrace with sustainability for the strategic benefits that it has, the way to do it is, and you can download this document, is to look at what you currently have in place across ESG, because you'll have a lot in place. You do a stock take. Step 2 is you say, who are my stakeholders? What would they like me to focus on? Because I'm doing this to get benefits. And the benefits come through stakeholders, whether it's investors, financiers, customers, people, etc. Then step 3 is really contrasting and comparing. What do I have in step 1? In step 2, what do stakeholders want? What's the gap? And how do I fill the gap? How do I commit to fill the gap? Step 4, if I want to prove to people that I'm addressing what they want, they don't want stories, they want me to measure it. They want data to support it. So stories and data together. So I have to start measuring. I need data. And then step 5 is I report. Now I can report a voluntary report. It could be very formal, informal. It could be following a framework or just following what's important to our stakeholders. It could have assurance or not, and then we improve. So I think from a voluntary perspective, this is still the way to address it. If you look at, we step through each step. So how do we assess what we currently have? We look at how do you prioritize, so how do you do a materiality assessment, how do you engage with all these stakeholders. It doesn't have to be physically running workshops or surveys. It could be desktop reviews. It's voluntary, so you decide how you want to do it and what is a cost-effective way for you to do it. So what we're trying to do is say these are all the sustainability topics. Through outreach to stakeholders and our own business, which of these topics should be our focus on a voluntary basis. And we look at who are our stakeholders, who are the people important to us, who are key customers, key investors, potential future investors, financiers, maybe it's a PE fund, maybe it's a bank, etc. And we engage with them. So we have to do this smart. And then we commit, we fill the gap, we measure, and we report ultimately. So the outcome of that stakeholder engagement is something like this. And this is what we've done for BDO in 2022. By the way, we're busy redoing this for 2025, and I can't wait to see whether our stakeholders over the 3 years have changed their views on what should be important to BDO. So, this is what it should look like, and we should focus on that green block. And then we start to improve. So the checklist you can download. I think it's a very useful document. Then also I thought I'll put in here an example of a voluntary sustainability report. There's a link to the report. This is BDO's voluntary sustainability report for our own business for 2024. It was the 3rd time we've prepared this report. Absolutely a voluntary sustainability report. It's not looking at AASB S1. It's not looking at climate focus. That will go into our annual report in 30 June 2026 because we're a Group 1 entity. But we still see the strategic benefits of doing a voluntary sustainability report. This is an amazing example. I've not been involved in this at all, so I can say this is an amazing example. Our internal team have done great work in putting this together. So how BDO can help you? Really important, we can help with that carbon accounting, whether it's for strategic reasons or mandatory reporting. If you look at sustainability reporting, that particular bucket, on the next slide, you can see we differentiate between, we can help you with mandatory reporting, we can help you with voluntary reporting, and we can help you with strategy. We can help you with materiality assessment, stakeholder engagements, and that whole journey. And obviously, our assurance providers can help. We've got a full team across the country that can help you with various aspects from an advisory perspective. So please feel free to reach out. We've got sustainability assurance partners that can assist. So please feel free to reach out. We've got our monthly newsletters. So I think for me, the key message today is please don't forget about the power of voluntary sustainability reporting. I know for the rest of the year in the webinars, we're going to really focus on AASB S2 because it's important to get ready for compliance. It's important to be assurance ready around climate. And there's a lot of other benefits to focus on climate as well. But that's not the only thing. So I hope that gives you some information. And I love the words that the US and Europe intend to stay the course on sustainability. And really what they're saying is staying the course on voluntary sustainability reporting. Thank you very much for joining today. I hope you have a great day. We'll speak again next month when we start with AASB S2.